Good morning, guys, and a very warm welcome to all of you to the new chapter on IPCC. This time, I'm going to take IPCC chapter number 11. The name of the chapter is Financial Statements for the Non-Profit Organization. Before I go ahead with the chapter, guys, let me introduce myself. My name is Rahul Malkan. I have also taken few chapters in IPCC before, and I hope you enjoyed it. Same as this time, I'll take you through the basic fundamentals of the chapter and also the practical aspects. By the end of the chapter, I hope you guys will be in the position to solve the questions by yourself. In case you have any doubts, I have given my email ID at the end of the chapter so that you can get in touch with me. Are you clear, guys? And you can even take the printout of the slides and you can just go through them. Anyways, let us go ahead with the chapter and let us first clear the basic fundamentals, the theoretical part, and then I'll take you to the practical aspects. How about it, guys? Can we start it now? Perfect. Thank you, guys. Let us start with the basic introduction on the chapter. So, what is non-profit organization? A non-profit organization is a legal and the accounting entity that is operated for the benefit of the society as a whole rather than for the benefit of the sole proprietor or the group of partners or shareholders. Guys, this entity operates for the benefit of the society. They intend to give the benefit to the society. They intend to work for the society, provide service to the society. They don't intend to make profit for themselves. So main part is what you're going to concentrate. It intends to work for the benefit of the society. Taking it ahead, in every society there are some organization or organizations which are found which do not have profit making as their objective. And these are the organizations or entity, they don't intend to make a profit. Profit making, that's, just have a look at this part again, which do not have profit making as their objective. Are you understanding what am I trying to tell you? Now, it does not, don't misinterpret me. I'm not telling you that they don't make profit. I'm telling you they don't intend to make a profit because their objective is providing services to the people. Are you clear? Taking it one step ahead. Now, as I said, their main objective may be social or educational or religious or charitable, and they may take the form of clubs or societies or charitable bodies and so on. Now, their aim can be, their objective, for example, can be educational, is to spread education, to provide education free or at a very subsidized rate to the people. Or it can be religious, or it can be charitable, and they do take the form of clubs or societies or charitable bodies. So what is non-profit organization to sum it all? It's a legal and the accounting entity, not intending to make a profit. The main objective is not to make a profit, but to provide services. Are you clear, guys? Taking a leaf out of the basic introduction, we can put certain characteristics of an NPO. Now, whatever we have learned in introduction, I'm just summarizing it a bit. The characteristics of an NPO are, now you can see them. The first one is entity, service, form, funds, financing, no profit motive. The first one to start with is an entity. An NPO is an organization or an entity. It has a separate legal form, separate from the person. Second thing, it intends to provide the service. This is the main part. It intends to provide the service to the society. Do you agree with that one? Third one, the next part is the form. It may take the form of a club or a society or a charitable institution. Do you understand that? Funds. Now they may gather the funds from donations, from government helpings. Financing is exactly the same. Financing of an NPO is taken up from donations that we receive, or it can be like, some people leave the legacies behind, so that's a form of financing. And let's not forget, the most important part of an NPO is no profit motive. I would again like to remind you guys, don't misinterpret me. I don't say they don't make profit. I say they don't intend to make a profit. Means their main objective, even, when I say don't intend, it's like basic objective in their mind is to provide a service, not to make a profit. Are you understanding it, guys? Perfect, ekdam. We now exactly know what an NPO means. It's an entity or an organization which intends to provide the service, and profit making is not their main objective. Going ahead, let us look at the accounting aspects. Now, what are the financial statements that an NPO is required to prepare? Financial statements. These organizations prepare at the year end the following three financial statements. I mean to say three financial statements. The first financial statement is the receipt and payment account. The second financial statement is the income and expenditure account. And the third financial statement is the balance sheet. So, an NPO prepares three financial statements. First one is the receipt and payment account. Second is the income and expenditure account. And third one is the balance sheet. How about taking a brief preview on all three of them? Take the first one, the receipt and payment account. Now, a receipt and a payment account is basically like a cash and bank account. Yeah, cash and bank account. Receipt, debit what comes in, payments, credit what goes out. The second one is an income and expenditure account. Now, this income and expenditure is very much similar to the profit and loss account. Basically, the rule follows is debit all expenses and losses and credit all incomes and gains. Yeah, we don't call it as profit and loss because, as I kept on telling you, the intention was not to make a profit, and hence the word profit and loss is substituted by income and expenditure. And the third one is known as the balance sheet. Now, it's a normal balance sheet, nothing new about it. It will have liabilities on the left hand side and assets on the right hand side. So, three statements. I'll take all statements in detail. The first one is known as receipt and payment. The second one is known as income and expenditure, and the third one is known as balance sheet. Are we clear, guys? Too good. Let us go through each financial statement in detail now. Let me start with the first one. The first one is the receipt and the payment account. Now, the receipt and payment account is a cash book. It is a summary of all cash transactions. It starts with the opening cash and bank balance and it ends with the closing cash and bank balance. All receipts, that is cash and check, are shown on the left hand side, that is the debit side, and all payments, that is cash and check, are written on the right hand side, that is the credit side. Now, to summarize, it's an account. Now, when I say it's an account, it is having two sides. One will be the debit side and second one will be the credit side. Now, what will debit side record? Debit side will record all receipts and credit side will record all the payments. So, debit side records all receipts and credit side records all payments. It starts with the opening cash and bank and it ends with the closing cash and bank. And as simple as that, starts with opening cash and bank, ends with closing cash and bank, receipts on debit, payments on credit. It's like a cash book, summary of all cash transactions. Are you clear with that one? Let us characterize this, whatever we've written in paragraph, in point-to-point format so we understand it better. Now, as I was telling let us characterize these features in point-to-point format. What are the characteristics or the features of receipt and payment account. Now the slide tells you the features of receipt and payment account are as follows. It's the first one. Now it's a summary of cash and bank transaction. So it records all cash and bank transaction, cash and check basically. The point number 2, it starts with opening balance of cash and bank and it ends with the closing balance of cash and bank. Opening cash and bank and the closing cash and bank. Starts with opening, ends with closing. Point number 3, all receipts are recorded on the debit side. All payments are recorded on the credit side. T format. Debit side, receipts, credit side, the payments. Point number 4, it records all receipts, guys. It records all receipts, irrespective of the period to which it belongs to. Now, for example, let's say I'm preparing accounts for the year 2012, Jan to December. Now, the receipts will include all the receipts received in this particular year, irrespective to which year they belong to. Now, if we are receiving the amount in 2012, even if the amount belongs to the year 2011, it will be recorded in the receipt and payment account. Or even if the amount is received for the year 2013, it will be recorded in the receipt and payment account. Now that's what I'm saying. It records all receipts and payments irrespective of the period to which it belongs to. Means it records the receipts and the payments for the past, for the current, for the future period. Now that's what I mean to say, for the past, for the current, for the future period. An account for 2012 may include the receipts for the year 2011, for the year 2012 and for the year 2013 also. The only criteria it should fulfill is it should have been received in the year 2012. The next point. Take the next point. The next point is that the receipt and payment account records all receipts and payments irrespective of its nature. That is, it records both the revenue and the capital receipts and the payments. For example, guys, take an example of payments. Payment of salary, payment of rent, purchase of furniture. They all will be recorded on the payment side. Now, but analyze it. Payment of salary, it's a revenue expense. Payment of rent, it's a revenue expense. The third one I told you was purchase of furniture. Purchase of furniture is a capital expenditure, but still it will be recorded on receipts and payments on the payment side. And it will be very much similar to receipts also. Receipts also will record both the receipts. It can be a revenue receipt or it can be a capital receipt. Are you clear? The next one. It does not record any non-cash transactions. Any non-cash. It does not record any non-cash transactions. It will record only cash and the check transactions. Take the next point. This account is not a trial balance. It is not a trial balance, guys. Don't misinterpret this account as trial balance. But yeah, definitely it's a cash trial because it contains all transactions with reference to the cash and the check. Are you understanding it? To summarize, if you remember all the points, it starts with opening cash and bank, ends with closing cash and bank. Receipts on the debit, payments on the credit. It records receipts and payments irrespective of period to which they belong to. It records receipts and payments irrespective of its nature. It does not record any non-cash transactions, and it is not a trial balance, but it is a cash trial. To make it more clear with reference to the characteristics, I am putting a specimen of receipt and payment account in front of you. Have a look at the specimen. To start with, first on the top line, have the name of institution, that is the club. Receipts and payment account for the year ended 31st March 2011. Now please remember the year, it's 31st March 2011. So the current year will be 10 and 11. Yeah, it will have two sides, one is debit and second one is credit. Format is very simple. Receipts and a column of amount and payments and a column of amount. Now, as you can see, it's starts with two: opening cash in bank. We have subscription for 9, 10, 10, 11, entrance fee, donation, sale of furniture, interest receipt. On the opposite side, we have salaries, rent, electricity, purchase of furniture, investment, machinery, sundry expenses, cleaning expenses, insurance expenses, books, and the closing balance of cash in bank. Take a rewind. Start understanding what all I told you guys. What all I told you. The first one, it starts or it records the receipts on the debit side. It records the payments on the credit side. Receipts on debit and the payments on the credit. Do you agree with that one? The next thing I told you is records or it starts with the opening cash in bank and it ends with the closing cash in bank. Receipts on debit, payments on credit, starts with opening cash in bank, ends with closing cash in bank. Third thing, it records all receipts irrespective to the period to which it belongs to. Check this out. We are talking about subscription. The current year was 10 and 11, but we have received subscription for 9 and 10. We have received it for 10 and 11, and we have received for 11 and 12. 9 and 10 is the last year. 10 and 11 is the current year, whereas 11 and 12 is the next year. So, irrespective to the period to which it belongs to, receipt and payment records all receipts and all payments. So, next one to note about it is, have a look at the receipt side, the thing I'm highlighting. Have a look at this part. By entrance fee, by donation, by sale of furniture, by rent received. Take the last two, sale of furniture. Now, sale of furniture, the amount received by the sale of an asset is a capital receipt, but it is recorded on the receipt side. The rent received is a revenue receipt, but still it is recorded on the receipt side. So it records all receipts irrespective of its nature also. Both the capital and the revenue receipts are recorded on the receipt side. Similarly, if you go to the payments, check this portion out again. The payments. We have electricity, purchase of furniture, repairs, purchase of investments, sundry expenses. Now, electricity is a revenue expenditure paid every month, every year, every quarter. Purchase of furniture. Now, purchase of furniture is not a revenue payment. It's a capital expenditure. Purchase of investment is a capital expenditure. Repairs of machinery is a revenue expenditure. What I mean to say is, it records all payments, irrespective of its nature. Do you understand this, guys? Next thing, you should keep a note, it does not record any non-cash transactions. Does not. You check on the receipt side, check on the payment side, it does not record any non-cash transactions. So, the summing up is quite clear. Debit, receipts, credit, the payments, starts with opening cash in bank, ends with closing cash in bank, records all receipts irrespective to its period to which it belongs to, records all receipts and payments irrespective to its nature, and it does not record any non-cash transactions. Guys, are you clear with this account? Yeah, because there are only 3 accounts now, so 3 statements. We need to understand those 3 statements. So one of them was receipts and payments. Let us have a practical example on receipt and payment accounts. What's it, guys? I gave you the specimen now. Let us see if you can crack this illustration. I've taken it from study material, that is illustration number 1, page number 9.2. Now, I would like you to solve it so that you can check it out whether you're getting it correct or not. The receipt and payment account for Swaraj Club for the year ended 31st December 2010 were entrance fee 300, membership fee 3000, donations for club pavilion 10,000, foodstuff sale 1200, salaries and wages are 1200, purchase of foodstuff is 800, construction of club pavilion is 11,000, general expenses are 600, rent and taxes are 400, bank charges 600. Cash in hand on 1st Jan is 200 and 31st December is 350. Whereas the cash at bank on 1st of Jan is 400 and on 31st December is 590. Are we clear, guys? Now what we need to do is prepare our RNP. So it will start with opening balance of cash in bank given to you, ends with closing balance of cash in bank. Receipts should be debited and payment should be credited. Start thinking from the viewpoint of the club, not from your viewpoint. We are in the books of Swaraj Club. So what are the receipts in the books of Swaraj Club? Now entrance fee will be a receipt. Membership fee will be a receipt. Donation for club pavilion will be a receipt. Foodstuff sale will be a receipt. Salaries and wages will be a payment. Purchase of foodstuff is a payment. Construction is a payment. General expenses, rent and taxes, they are payments. Simple. Start with opening cash in bank, end with closing cash in bank. Debit the receipts, credit the payment. Try this out, guys. So are you done with the solution? Check your answers, guys. Now here is the solution in front of you. First one, on the top line, the name of the club, that is Swaraj Club. Then we have receipt and payment account for the year ended 31st December 2010. The receipt and payment account will have two sides. First one the debit and second one is the credit. Debit the receipts and credit the payments. As I told you guys, it should start with the opening balance of cash in bank. To balance brought down, cash in hand, cash at bank 200 and 400. Simultaneously, it should end with the closing balance of cash in bank. So by balance carried down, cash in hand is 350 and cash at bank is 590. Are you clear with that? Now start debiting all the receipts. We had entrance fee for 300, membership fees for 3000, donation on account of club pavilion was 1000, and we had sale of foodstuff at 1200. On the payments, we had wages and salaries at 1200, purchase of foodstuff at 800, and club pavilion expenses for the construction were 11,000. We had general expenses for 600, and finally we had rent and taxes for 400. Now we should try tallying this amount. Okay, we also had bank charges for 160. Now we should try tallying this account. It must tally at 15,100. The total of the debit and the credit should match at 15,100. Are you clear, guys? Are you getting this answer? Let us go ahead. Let's go to the next financial statement. The first one was receipt and payment, and the next one is income and expenditure account. Now what is income and expenditure account? Income and expenditure account is equivalent to the profit and loss account of the business enterprise. It is prepared by matching the revenues against the expenses for the specific period, and the specific period is usually a year. Matching revenues against the expenses means on one side of the account we will record the expenses, on the other side of the account we will record the revenues. That is income and expenditure. However, since this is not a profit-oriented institution, the account is not known as profit and loss account. The account will be known as income and expenditure. We have just replaced the word profit and loss with the word income and expenditure. And the balance of this account will also not represent the profit or the year. Now, the balance will not be known as profit or loss. The balance will be known as a deficit or the surplus. Now, deficit if the expenses are more than income, or surplus if income is more than expenses. Are we clear with this, guys? Now, as we did in receipt and payments account, let us repeat the procedure in income and expenditure. I mean to say is let us look at the features of the income and expenditure account. Now, the features of income and expenditure account are as follows. Point number one, it's a revenue account prepared at the end of the financial period. Now, when I say it's a revenue account, that means it's a nominal account. And it is prepared at the end of the financial period. It's prepared generally once a year at the end of financial period. Point number two is this account is prepared by matching expenses against the revenue of the period concerned. What is more important is the expenses and the revenue should belong to a particular period. Now, as we said, if it is prepared once a year, so we are going to match 1 year of expenses with the 1 year of revenues, and it should be the same period. Point number 3, all expenses are shown on the left hand side, that is the debit side. And point number 4 is all incomes are shown on the right hand side, that is the credit side. Now, that was very preliminary, in fact, from the first point itself. When we said it's a revenue account, it means the rule says debit all expenses and losses and credit all incomes and gains. Next one, let's go to the next point. The next one is point number 5. The income and expenditure account will consider both the cash as well as the non-cash items. Now, for example, on the expense side, we might find salary, we might find rent, and we may also find something that is known as depreciation. The salary is a cash expense, rent is a cash expense, but depre is a non-cash expense. So it considers both the cash as well as non-cash items. Next one, the point number 6. All capital expenditures and income are excluded from the income and expenditure account. If you remember, just 2 or 3 slides back, we were doing receipts and payments, and it said it records both capital as well as revenue items. However, income and expenditure excludes the capital items. It does not record the capital expenditure, it does not record the capital incomes. Items like purchase of furniture, which was included in receipts and payments, will be excluded from income and expenditure. It is not a revenue expense. It's a capital expense, and hence it will not appear in income and expenditure. Next one, point number 7, is only the current year's income and expenses are considered. Current year's income and current year's expenses are considered. Now, here it's very important whether the amount that is received belongs to the current year. Because if the amount is received for the previous year or the next year, then it should not be included in income and expenditure. Again, what is important is if the expenses or incomes are incurred. Even if expenses are incurred for 12 months, though paid for 10 months, it will be considered as an expense for 12 months and included in income and expenditure for 12 months. Even though if they are paid for 10 months. The next point, the last one. If incomes, now while balancing that account, if incomes are more than the expenditure, then the balance will be known as surplus. Whereas if the expenses are more than the incomes, then the balance will be known as deficit. The receipt and payment used to start with opening cash in bank and end with closing cash in bank, and the account used to tally. Your income and expenditure needs to be balanced. It's like a profit and loss account. To find out the profit here, in that case, it will be known as surplus, and the loss here in NPO accounts will be known as a deficit. Are we clear with that one? So to sum it up, income and expenditure account is prepared for a period. It's a revenue in nature. Debit the expenses, credit the incomes. Only revenue items are considered. Only expenses for a particular period are considered, income and expenses both. And it considers both the cash as well as the non-cash items. Let me give you the specimen of income and expenditure account so that we can clearly understand as to what I was talking. The specimen of income and expenditure, put right in front of you. First one is the name of institution or the club. That's always a practice. Income and expenditure account for the year ended 31st March 2011. We have 2 sides. First one, debit and the credit. On the expenses, salary outstanding, rent, insurance, prepaid, printing, repairs, debris, sundry expenses and surplus. That is a balancing figure. Income, by subscription outstanding, ad, less advance, donation, entrance fee, sale of whole newspaper, sundry receipts, and the rent, and the total. And we can see we have a surplus. Now let us put everything that we tried into practice. First one. An income and expenditure account is a revenue account which says debit all expenses and credit all incomes. So debit starts with the expenses and credit starts with the income. Do you agree with that one? It records all expenses. Now when I say it records all expenses, that means the cash as well as the non-cash. Check this out. You can see printing and stationery, repairs of equipment, and you can see even depreciation. Printing and stationery, both a revenue expense. Repair to equipment is a revenue cash expense. Both are cash, printing and the repairs. And debris is also revenue expense, but it's a non-cash, so it records the cash as well as the non-cash expense. One more point to be noted is, it records expenses for a particular period. Now you look into this block, salary, add outstanding. Now, irrespective of the salary is paid for the entire period or not, we would add the outstanding and put it for that period. Whereas you can see for the insurance, less prepaid. That means if insurance is paid for the next year, we would subtract it as a prepaid and show it only for that particular period. So here the expenses are recorded only for that particular period. Do you understand that? Finally, when we close the income and expenditure account, we can get the balance. The balance is either a deficit or a surplus. In this case, if you see, we have something that is known as surplus. Why do we have surplus here is because the total of income side is greater. So if income is greater than the expenses, then the balance will be known as surplus. However, if expenses are more than income, then the balance will be known as deficit. Clear ekdam? Chakas. So having understood both the accounts now, income and expenditure and receipts and payments, let us put them in front of each other. That is, let us make them fight. Distinguish. I'm joking, guys. Let us have distinguish between the R&P and the income and expenditure. Yeah, actually in our school days, whenever they used to say distinguish, it was like against. So it was like a fight between R&P and income and expenditure. T format, account. Always love that. One side, the receipts and payment, and second side, the income and expenditure. Point number one. Receipts and payment is a real account. The rule is pretty simple. Debit what comes in, credit what goes out. Income and expenditure account, on the other hand side, is a nominal account. Debit all expenses and losses and credit all incomes and gains. The next part. Receipts and payment is a summary of actual cash receipts and the payments for a particular period. It's cash, pure, hardcore cash, debit, the cash, credit, the cash. Whereas, income and expenditure account is a summary of income and the expenses of a particular period. It's a summary of income and expenses, not cash. Point number 3. Receipts and payment includes both the capital and the revenue items. So capital and revenue receipts as well as capital and revenue payments. Whereas income and expenditure includes only revenue items. Only revenue. Point number 4. The receipts and payments includes all receipts and payments irrespective to the period or of the period to which it belongs. The only point of view is it should be received in the current year. Then it does not matter whether it belongs to the previous year or the current year or the next year. The only thing that matters is it received in the current year, it is recorded. Whereas income and expenditure will include only the income and the expenses of a particular period for which the account is prepared. It will include the income and expenses only for a particular period, not for the previous year or the next year. Even if the amount is not paid and incurred, it will be recorded as an expense. Are you understanding, guys? Next one. The receipts and payments will not include non-cash transaction. It does not include non-cash transactions. Whereas income and expenditure includes both the cash as well as the non-cash transaction. Receipts and payments will be pure cash, and income and expenditure will include both the cash and the non-cash. Next point, the last one. Receipts and payments starts with opening balance of cash in bank and it ends with the closing balance of cash in bank. And it should tally. However, there will be no opening balance of income and expenditure, but the closing balance will either represent a deficit or a surplus. Now, deficit, as I told you in the last slide only, is if the expenses are greater than income, then we have a deficit. It basically represents the loss. And if the income is greater than the expenses, then we have a surplus. It represents the profit. Are we clear? That's receipts and payments versus income and expenditure. Perfect. The last financial statement, that is the balance sheet. Now, nothing new about the balance sheet for a non-profit organization. It's prepared exactly on the same fundamentals as it is prepared for any business, for any profit-seeking business. Now, the screen says the balance sheet of non-profit concern is prepared on same principles as the balance sheet of profit-seeking. It's a statement of all the assets and the liabilities of the business. It may be prepared either in the order of liquidity or in the order of permanence. Now, when I say in the order of liquidity, then the asset should start with cash, then bank, then debtors, then stock. If I say it is in the order of permanence, then it should start with fixed assets and then go on to current assets. But all in all, nothing new about this balance sheet. It's just that it was one of the statement and I put it in the slide. But it is same as the normal balance sheet. So that's the balance sheet. The specimen of the balance sheet now. We have seen the balance sheet, but still for you, a little bit of a difference here and there that you need to know, that is name of the institution starts with the balance sheet as on 31st March 2011. We all know it that on the left hand side we have something that is known as the liabilities. Do we agree with that one? Here are the liabilities. On the right hand side we have the assets. Now, liabilities and the assets. It starts with the capital fund. Add anything that has to be capitalized. We'll study this words, entrance fees and subscription and all. Surplus. Yeah, we know that in case if we have a profit, it's a surplus. It should be added to capital fund. Then we have any income received in advance, that is basically subscription, or any outstanding salaries, that is expenses, price fund and building fund and so on. On the assets we have building less the debris, furniture, books, investments, prepaid insurance, outstanding income, subscription, cash at bank and cash in hand. And we all know that it's a universal rule which says balance sheet must tally. It has to tally. Every question that we solve has to tally, guys. Are we understanding it? That's the balance sheet, and this balance sheet is prepared in the order of permanence. Clear? Cool.